Welcome to the very first instalment of Conversations on the Couch here at Empire. The scale of the funds that we manage here at Empire and the collective contacts and reach of the professionals that we've put together on the Empire Investment Committee means that we have access to some of Australia's leading fund managers who manage funds both here in Australia and globally, and access to fund managers that might not always be available in most retail environments or available to most other advisors. So we're in a very privileged position to be able to offer this type of solution to our clients. And what that also means is that we have access to the people who are actually pulling the levers in these funds, the ones who are making those final decisions on what to buy, what to sell, and having that direct access to them gives us the ability to advise our clients in the most informed way possible. Today I've got the portfolio manager of the Quay Global Real Estate Fund, Chris Bedingfield, in the office with me. Chris spent some time giving some of our advisors in the office a briefing today on what's happening in the Quay Global Real Estate Fund, and I've now got the opportunity to get him here and to share some insights that he shared with me and with the rest of the team with the wider Empire community. So, Chris, thanks for coming along today.
My pleasure. Great to be here.
Wonderful. Now, look, I guess just a bit of for a bit of an opening understanding of where the Quay Global Fund is operating. What are global REITs? What are G REITs?
Yeah, it's a good place to start. The word REIT, Real Estate Investment Trust, is meant to describe the legal structure in which most real estate is held in the listed environment. So that's the way we access most of our investments, is via acquiring listed REITs. I think it's very important also to say that we don't just buy REITs, we also buy. REIT legislation is not available in every country in the world. So for instance, in places like Europe, they are still companies, but essentially what we try to do is buy listed entities, whether they be REITs or companies, where the assets are very passively held, the real estate is being built, and the cash flows and the rents are already in place, and the cash flows are quite certain and transparent.
In the Empire portfolios, we've made the decision to focus on global REITs rather than Australian REITs. Why do you think, apart from the fact that you are a global REIT manager, do you want to share with our listeners today why you think that's a prudent choice?
Yeah, I think there's a couple of reasons, and in very simple terms, it's return and diversification. So from a return point of view, if you look at global real estate over the last 20 years, say this century, global unhedged real estate has actually been a very good performer relative to domestic REITs, relative to domestic equities, even relative to global equities. It's actually been a very, very solid performer. So you get very good returns out of global listed real estate. And then the second part of that is you get a wider choice of opportunities. So in Australia, you really have the larger REITs tend to be in the areas of industrial and retail and office. But when you look globally, there is a much wider opportunity set. We have access to sectors such as life sciences. We have access to single family rental accommodation or apartment rental accommodation, manufactured housing, self-storage, so triple net leasing. So sectors that are either not really available in the listed environment, or if they are available, you've got very, very limited choice. And so I think when it comes down to looking at global real estate as part of your asset allocation, it's those two factors. The returns are very, very good historically, but you also get that great level of diversification where you can invest in many different styles of asset classes, some of which are very defensive. Student accommodation, for instance, very defensive. Single family housing, very defensive. Or if you want to play the cycle a little bit more, then you could be a little bit more towards that office or retail. So it's really a question of choice as well as return.
The single housing bit's really interesting for me, and I guess why we can access it in a global sense with a better return. I guess typically single housing yields in Australia have tended to be relatively low in return for the fact that they've been quite defensive in that they don't carry probably as much tenant risk as other types of real estate.
Yeah.
But on a global level, we can access the relative security of single residential, but with higher yields. Is that a fair statement?
That is. I think that's a very accurate statement. So yields in Australia tend to be very, very low, structurally very low. When we talk yields, let's be clear what we're talking about. We're talking about net yields. So in Australia, you obviously get the gross rent, but then you've got the outgoings and costs associated with maintaining the real estate. And so when you look at yields in Australia, they can be as low as 3 or 2.5%, 3%. Maybe a little bit higher, but when you look at companies, say in the United States, you can get yields of 4.5%, 5%, even up to 6% in really good locations, professionally managed and well financed. And the other thing I would say as well about residential, particularly US residential, where we see a lot of opportunities right now, if you look at the long-term rent growth, it's never fallen. It's an extremely defensive asset class. At the moment, rents are very, very strong as part of the CPI problem we've got. We're happy to invest in that because we're benefiting from that. But even during the global financial crisis, where there was a housing crisis, rents never fell. So it's extremely defensive. The yields are very good. The total returns we think are very, very good. And we have the pleasure of having someone else manage and collect the rents for us and manage the funding for us.
One of the benefits of having active management in this space means that we don't just buy everything that's represented in the index. And one of the things that I think is really interesting is that in this particular portfolio, how low our exposure to office real estate is. And when we compare it to the wider index, where it could sit at circa 12%, we're probably in this portfolio sitting at under 2% or 2% thereabouts. So compared to the index, we're very light on office, which is a conscious decision. You want to share why that decision's been made?
Office is always challenging. It's about, as you say, about 2% or 2.5% of the fund today. That's historically high for us. So leading into COVID, we had nothing in office, and that served us well during COVID. And then prices have changed. Prices always create opportunity, and we think we've found a small opportunity. But it is a challenging asset class, and a lot of people talk about the work from home and what that's going to do to office, and that's a very valid debate to have. The wider debate that has steered us away from office more generally has been the fact that the maintenance capex required in office buildings is very, very high. 30 cents in every rental dollar really needs to be put aside for long-term incentives, maintenance and repair within buildings. And so the free cash flow out of office buildings is way lower than people, I think, sometimes realise. And so when you look at our portfolio, we tend to have a lot more in areas like self-storage, which only less than 5 cents in every rental dollar is actually needed to maintain. You think that makes a lot of sense because self-storage is just a slab with a shed on top and some locks.
Some of those decisions, and you mentioned where you were sitting prior to COVID, and that it bode you well, and this fund during that period there. We've had some pretty good results coming out of this particular fund relative to the index and relative to your peers. So we feel like we've made a good decision in including this fund in our portfolios. Do you want to give us a bit of a general overview as to why you think Quay is the right manager to be using when investing in this particular sector?
I think when we started the business, we saw an opportunity to be a little bit different to the peers. I think that firstly, we are relatively, I suppose, concentrated. We only own 22 securities around the world. We're not really that interested in what makes up the index. We simply look for the best opportunities where we can find them. Sometimes those opportunities could be a $3 billion market cap stock. Sometimes the best opportunities can be a $60 billion market cap stock. We don't really care. We just go wherever the opportunities are. There is room for an index style, I guess, investment process, and there's, I'm not going to talk anyone out of that necessarily, but if you're really looking for a manager that's just obsessed about thinking and trying to find those best opportunities, that's what we hope to achieve and what we hope to present. And I think also we have a very, very strong focus on long-term downside protection in the way we invest. And the way we do that is we look to find investment opportunities where we can buy effectively below replacement cost. If we can buy a building or we can buy residential apartments, or if we can buy a single family house, if we can buy that at a 10 or 15% discount to the cost to build, we feel like long-term our downside is very limited.
And to finish our time on the couch this afternoon, Chris, what about just the general overview and outlook on where you think the real estate investment trust and property market's heading over the next year to 5?
I think over the next 1 to 2 years, the honest answer is I don't know. Real estate is a long cycle. And that's the way to really think about it. And I think anyone that's invested in an apartment or even their own house recognises that it's only over the fullness of time you recognise the quality of the investment you've made. I think over the next 2 years it's very, very hard to pick. I feel more confident when you get out to that 3, 4, 5 year period. What's happening right now is the cost to build is rising. It's rising for everything at the moment. It's rising for single family housing, self-storage, life sciences. That underwrites the next level of price increase, because unless actual prices meet those higher construction prices, you'll never build again. And in markets like the United States or in the UK or in Australia, where the population's growing, you have to build again. So the logic is really clear. If you buy below cost, and if you take that longer term view and you see inflation inflating that cost going forward, the outlook is very, very positive. Well,
Chris, thank you very much for coming along today. It was an absolute pleasure to have you come and present to our team and to have this discussion. And I hope that everybody watching got something out of this discussion here today. And if anybody's got any questions, please don't hesitate to contact our office.